So what we'll talk about today is how to get a whole life insurance policy and get as much cash value as possible. When it comes to getting whole life insurance, when people are interested in the cash value, there's often a lot of buyer's remorse. And the reason why is because people are often shown a policy, they're told this is how to get a whole life insurance policy, this is how to maximize your cash value, so they move forward with that policy, only to find out later the policy was not maximized for cash value. That results in buyer's remorse. I thought I got a good deal, and I found out I didn't get a good deal. So what we'll cover today is as follows. We'll start with the basics of whole life insurance, but then we'll talk about why people do this, specifically get whole life insurance policies for the cash value. We'll talk about how it works, specifically how to get a life insurance policy for as much cash value as possible. Look at where your money is going, what questions to ask. If you're looking at an illustration, we'll go over that. And then third, we'll look at an example of a policy, one that is set up like how most people get it, just a basic whole life insurance policy, and then another that looks really good. So let's get on into it and have some fun talking about cash value life insurance. So we'll begin with the basics. We've got a whole life insurance policy. You've got three different colors here. Let's start at the top with purple. That's your death benefit. Here we've got $500,000. What happens with most whole life insurance policies is over time, you will see that death benefit gradually increase. Now it might start out level sometimes, but as time passes, you will see it eventually go up. Next, in blue, we've got your payment. This is the money you are actually paying into the life insurance policy. Now, with respect to your premium payments in a whole life insurance policy, they are guaranteed to be level. When you hear the word whole life insurance, how long do you think you have to make payments for? Forever? Your whole life? That is the name of the product. The answer is no, it does not have to be for your whole life. It can be, but you could also stop it after 10 or 15 years if you wanted to. You could even stop after 1 or 2 years if you're starting with a large lump sum. So you do not have to pay premiums for your whole life. And then we've got the piece everyone is interested in, the cash value. Now what happens with the cash value of a life insurance policy? Similar to the death benefit, it gradually increases over time. Now you'll never see the cash value exceed the death benefit. Typically what happens is, if I look at an illustration when I'm 100 years old, if I make it that long, at that point in time, the cash value and death benefit will be equal with each other. But the cash value, regardless of what's occurring in the market, economy, even if it's not doing well, the market that is, your cash value continues to go up. So that's what people are interested in, specifically the cash value. Let's hit on exactly why. Why are people interested in the cash value of whole life insurance policies? There's three main reasons. Firstly, it's a safe place to put money. The net growth rate over time will likely fall somewhere between 3 to 5%, regardless of what's going on in the market or economy. Again, it is just consistent. I remember years ago, I was at a seminar and an individual said, in 2008, my whole life insurance policy made money. It just kept going up. So it's a nice peace of mind product in that respect. So number one, as to why people do this, safe place to put money. Number two, I can access my cash value anytime. And if I access it through a policy loan, I keep earning dividends and interest on my money. What that means is if you have $10,000 in cash value and you loan $5,000, you keep earning interest on the full 10. It keeps on compounding for you. Now we do have to account for the loan interest cost, but knowing that I can access it anytime without any penalties and I keep earning interest on everything is very appealing, especially to individuals that are actively using their money for business or real estate, for example. And then third, here's the big one. If we do everything properly, meaning we follow IRS rules, it's very easy to access the cash value completely tax-free. Those three reasons make sense. That's why people typically get whole life insurance and they get it for the cash value. So let's talk about the most important piece, which is how to get as much cash value as possible. So let's assume you're getting a policy similar to the one we just looked at on the left, where you want to put in, we'll call it 10 grand per year. So see up top, your payment in blue, 10,000 per year. That's what we're going to look at here. The first thing you could do is just buy a life insurance policy. What that means is I could say to you, here's a life insurance policy, here's your $10,000 going in, and I, the agent, am going to show you an illustration with that full $10,000. So here's your 10K. We're going to put all of it toward the insurance premium. How does that impact you? Here's what happens. Dollars that you pay to the premium typically build no cash value in the first year, and sometimes it's the first and second year, depending on the product. Now, if you ask, why does it work like that? The answer is because premium dollars primarily buy you life insurance up front. Now notice, I said the first year. As you continue to pay the premium, eventually it builds cash value, but it's not attractive. We're going to look at an illustration showing exactly this. So if you put the full 10,000 toward the premium, that doesn't look good. Can you put it anywhere else? A lot of times people don't think you can, because I hear insurance. In order to get insurance, I pay what is called a premium. Here's the thing. I can also put money here toward my paid up additions rider, or call it a PUA rider. I like to call it a cash dump in because money I pay here shows up in cash value. So let's pretend I'm going to put the full $10,000 toward the PUA payment. Now what happens? I see that show up in cash value. On day one, I might see $9,500. So there is a fee associated with that, but it begins to earn interest and quickly exceeds what I paid into it, typically after a year, 2 years at the latest, but it's typically after 1 year. Now, that money I can access anytime. That money begins to earn the guaranteed interest rate. I start to earn dividends. Putting money toward the PUA rider accelerates the cash value growth of a life insurance policy. Now, it will buy you some life insurance, but it's very small compared to the premium. You might get a 1 to 3x multiple in life insurance of what you pay into the PUA rider. Meaning if you paid in 10 grand, you might get another $30,000 in life insurance immediately. Does that make sense? Okay. So, a question that comes up sometimes is, can I just do that? Put everything into the PUA payment? The answer is no, unfortunately. We can't do that because there are limits we need to be aware of. So it's really just having awareness of the limits. And what you'll find is with the top companies, which I'll pull up in a moment, we can typically drive that premium as low as about 10%, which means the other 90% can go toward PUAs. So if I'm paying $10,000, this means I can drive my premium as low as $1,000. That portion does not show up in cash value in the first year. And then I can put the other $9,000 into PUAs, which will show up in cash value, which makes me feel like this. All right. Now, when we set up a policy in this manner, what you will always see is a term insurance rider attached. And the main reason why, it goes back to that tax-free piece where we said it's tax-free if we do everything properly. Adding a term insurance rider prevents what is called a modified endowment contract. It's a taxable event on a life insurance policy. We want to avoid that, and a term rider is the least expensive method to accomplish this. You can add a term rider depending on your age for a couple $100 per year, and you don't have to carry it forever. So it's a much better alternative than carrying a high premium. which you would need to prevent a mech if you don't have a term rider. Okay, so key lesson here. If you're going to pay $10,000, I would ask, how low can I set the premium? Because I know the premium does not build cash value up front, and it also slows down my cash value growth. So how low can I set the premium with the particular insurance company that I'm looking at? With your top companies. There are 4 of them. They are referred to as your 4 major mutual companies. The lowest we can set the premium is typically 10%. There are some exceptions to that. It's not a hard 10% rule with your top companies. But first, let's look at our companies. We've got Mass Mutual, Guardian, New York Life, and Northwestern Mutual. An example of one exception is if I look at Guardian, wherever I set the minimum premium, I can pay 10 times that per year into PUAs. That's the most we can illustrate in the software. But in the first year, I can actually go up to 50 times the base premium. So I can start with a large lump sum and really just plow money into PUAs. And all companies have different rules and nuances to be aware of, which we've got other videos where we'll go into that, where we go into that in full detail. But policy design, minimize the premium, maximize the PUA rider, that will maximize cash value. We're going to look at that in a moment. What it also does is give you a lot of flexibility. When you start a policy, you're committed to this, the premium. You can add PUAs often at your discretion. So now this guy who wants to pay 10K is all of a sudden only committed to 10,000 and can add another 9,000 at his discretion. So let's take a look at an example of a policy here. First, we'll look at the most common approach, which is a great example here of what not to do, and then we'll make this policy look better. So what we've got is a traditional whole life insurance policy, and what we're going to start with is exactly that. So this is for a 40-year-old individual paying $20,000 per year. Why he's paying such a large dollar amount is because we just wanted a death benefit of $1 million. So he was sold a $1 million life insurance policy. Okay. It costed him $20,000. He's paying nothing into the PUA rider. So the column in red, that base premium of 20, matches the column in blue, which is what he's paying, $20,000 per year. How long does he pay into it? For 15 years. What's $20,000 times 15 years? $300,000. What's his cash value at year 15? $324. Okay. If this is you, how long did it take to get your money back? After 10 years, how much did you pay? $200,000. Do you have $200,000? No. He's got $192. 12 years takes to get his money back in this example. Seem like a good place to put your money? Sometimes we hear with setups like this where someone has to wait 7 or 10 or more years to get their money back is, hey, you need to look at it differently and think long term. It's like, no, I don't need to throw my money away to think long term. You can get the best of both worlds. Here you go. So here's the same product with the same insurance company. We just set it up differently. So cash value, yes, please. All right. So what we've got here, same out of pocket of 20K per year. The difference is, look at this. There's your 10% minimum premium. There's your 90% PUA. The true minimum plus the term is going to be about 12%, but we're just rounding here. And there's your cash value. Look at this. Instead of $700 in the first year, you've got $17,000 in change in the first year. When do you get all of your money back? Just about by the 4th year. You've paid in 80, you've got 79.9 in this example. So we could get that to 80 if we wanted to. Point is, you've got a lot more upfront. By the 15th year, you've got 407. That's a lot more than the 324 to the left. Here's a nice column that just gives you the difference. What do you notice here? A lot more money in the option to the right. This is how much more you have in cash value with this option compared to the one on the left. And again, same product with the same company, just set up differently, where we are reducing the insurance expenses as low as the insurance company will allow us to reduce them. Okay, that's how it works. Let's go back to our company selection here with the 4 major mutuals. There's a lot of life insurance companies out there. Why these guys? Why do I always talk about these? There's a big reason for this. One, when you look at them from a company size standpoint, they're all massive. When you look at how long they've been in business, they've all been in business for more than 160 years. When you look at their dividend history, it is quite stellar. Let's take a look here. Goes back further than this. But if we look at recent history on the bottom, there you go. 2024, 6.1%. For 2025, 6.4%. That's Mass Mutual. If we look at Guardian, there you go. Scroll up here, actually. Their dividend, most recent dividend in 2024 is up at the top left, 5.9%. But you can see that history. Look at this back in the late 80s and early 90s. All companies were like that. So strong dividend history with those companies, that's great, but you can see similar trends with other life insurance companies. So what else would I ask for? Or what else validates that it makes sense to go with these companies over another if I'm interested in getting as much cash value as possible? Actual performance, meaning ask for a policy that is at least 20 years old, and can you see that the cash value actually grew at an attractive rate over time? That's it right there. And this question is so rarely asked. Sometimes when I ask insurance companies, they get annoyed with me and they say, nobody ever asks that, get out of here. I'm like, all right. When I worked at an executive benefits planning firm where we worked with corporations who would put boatloads of money into these policies, guess what they would ask for, and guess what we would always look into? The historical performance of the insurance company that they are looking at. We want to make sure that that policy is not going to show good-looking numbers on paper and then under-deliver. What happens if you do that with a corporation putting in boatloads of money? Not going to be good, is it? They're going to come back upset saying, why did it under-deliver so much? This happens a lot in the life insurance industry. So what we've seen as a method to avoid that when we're interested in getting a policy for the cash value is looking at those 4 major mutual companies. Does that make sense? Here's some proof. So this is from a Blease report, which is just an independent study. And these are some older policies. And we've got the 4 major mutuals up top, and then some other companies below that. So what do you see here? Well, up at the top, you see Mass Mutual, then Guardian, then New York Life, then we've got Northwestern, Penn Mutual, Mutual Trust, and National Life. Now this study period is a bit dated. It's from 1984 through 2004. It's on a 45-year-old male. And the one item I like to note with this is that these policies were not set up for high cash value. It was the traditional approach. But when we look at the numbers back then and the actual internal rate of return, which is a fancy way of saying the average growth rate over time, what do you notice? Interesting, isn't it? There's your 4 major mutuals. Now these live through high dividend rates, so we won't see rates quite as high as this today, or not. They're getting better, but we won't see them this high. But my point is, all the companies live through the same dividend period. Why are some so much stronger? We've seen the 4 major mutuals produce. Now we've got plenty of case studies on more recent policies. We've actually studied every decade from 1975 all the way up to current. We study policies that we've put in place over the past 10 years, and we've seen this trend be consistent, where we've seen policies with the four major mutuals deliver the highest actual cash values, which is why we are a big fan of them when it comes to maximizing cash value. So I hope that you enjoyed this video. If you have any questions, please feel free to leave them in the comments below. You can also DM me if you'd like as well on any of our social platforms. And as always, I hope this helps. Thanks so much.